Okay, so the property market's falling everywhere, right? Maybe not. In this video, I'll share with you the property clock, which areas are falling, which areas are stagnating, which areas are recovering, believe it or not, and which areas are at the top of their upswing. So we're going to go around Australia, look at dozens of locations so you can select which area it is that you should be investing right now, or you should be running away from. If you're interested, carry on watching. My name's PK, and I help people build passive income through property investing using data, using the Property Investment Accelerator without putting down $15,000 on a buyer's agent every single time. And in this channel, we focus on the economy, Australian property, and financial happiness. Smash the subscribe button, give it a thumbs up, turn the bell on. Let's go. Okay, so the first thing I want to show you is the property clock right here, but a few things to tell you about it. Now, there's about, I would say, 4 or 5 different companies that produce property clocks like this in Australia. And the funny thing is, really funny thing is that they all have different locations of, around the property clock. So for example, here, Matusik is saying Brisbane and its downturn. Another property clock, let's say Heron Todd White, might say it's in its upswing or it's in its stagnation. So none of these are perfect. They're highly subjective. And the reason they're subjective is it's really hard to predict what will happen to a whole city or town, but it is much easier to predict what will happen to a suburb because data is richer, it's more saturated, it's more crisper for a microcosm of a location, i.e. a suburb. Okay, so suburbs are much easier to predict, according to me, based on my experience and everything like that, than whole cities and towns. And you look at Heron Todd White, right? And this is going off on a tangent here. But Heron Todd White, and I've analyzed it for the last more than 10 years. Sometimes you have locations going anti-clockwise on a property clock. Now, obviously, this is a clock, right? So this is 12 o'clock, this is 6 o'clock, and the whole idea is that a location moves from the peak to a declining market to a bottom and then rising market back up to a peak. But if you don't know what you're doing, or if you just follow these property clocks, you might buy in a location that's in its upswing, and then 3 months later, the property clock says it's actually in its recovery, and 6 months later, it's stagnation. So it doesn't make any sense, right? Get a directional view on these locations, and I'm going to be going through them one by one. Every location around Australia has its day in the sun, okay? So, I've been pretty vocal about not buying in locations like Woodridge in Logan, for example, but even that, every suburb, every location has its day in the sun. It's not about should you invest, but it's about where should you invest and when should you invest there. So the first key takeaway I want to share with you guys is, stick with me. The big one is right now, the majority of locations in Australia are going down in value, but that does not mean that you should not invest in property. It means that you should look for areas that are rising in value. And that is what I'm trying to demonstrate. Every property clock in Australia says that there are locations either in the recovery phase or in the upswing phase. So there are still markets going up. Let's start there. Darwin. Okay, so I'll go one by one. Darwin, it has gone up a lot, but compared to the rest of Australia, it hasn't really performed that well. I think it will outperform many other locations across Australia, perhaps in the next 1 or 2 years. But the reality is Darwin's always a higher risk market in the long term because a lot of transient, a lot of temporary labor that flies in, flies out, or gets a year contract and goes back to Sydney, Melbourne. And so it's not really the type of location that, sees, permanent migration that isn't highly reliant on LNG projects. It's a very resource-orientated city, good for some short-term growth. You might make some money out of flipping property there right now in the cycle. Long-term, I like buy and hold long-term with some value add. It's probably not the best location. Okay, Cairns, according to this, is in the upswing category. I would still say it's in the recovery category. I mean, Cairns prices are not too far off. Let's say 10 years ago or in the GFC, a place in, I don't know, Mount Sheridan on the south side, nice, high income families live there, good gentrification going on. They were selling in the GFC or around 2010 for about, I don't know, $400,000, and right now they're about 450, 500. So it hasn't really done that much. I would still say it's a recovery phase, and I think long term, whatever happens with interest rates and that, put that aside. In the long term, 5, 10 years, there's just no way a land and ocean locked, place like Cairns, hills on the left, ocean on the right, beautiful beaches on the north, completely developed out, almost south side, you can't develop too much more. There's no way prices can remain around 4 or 500. So I'm very bullish on Cairns, although it's performed very badly in the past. Always remember, past performance is not a good indication of what will happen in the future. You actually need to understand the dynamics and data right now. And everything that I'm saying right now is subjective, but it is based on data. Obviously, can't share with you, on dozens of suburbs in a single video. Gladstone, Mackay is typically quite, you could say, cyclical areas. There is a lot of supply going on in Mackay. A lot of investors going to Mackay right now, I'd be cautioning them because there are a lot of development approval pipeline. Increased supply is the enemy of growth. So don't just chase yields. Don't just chase yields because interest rates are high. You need yields, but focus on the right balance of supply demand, both in the rental market and the capital growth market. Rockhampton is, a little bit similar, although it's more diversified as it used to be. We have bought some properties in Rocky. I've mentioned suburbs there in previous videos. Check it out. You have to be careful of flood zones. Toowoomba, I kind of do agree. It is in the upswing. It's past its recovery, just like Townsville and Whitsundays. I really like these last three, and we've been buying in most of these areas as well. I would say Toowoomba, look, once again, over the next 10, 15 years, although it's already gone up about 50 or 40% in the last 2 years, I think there's a lot of long-term potential there. And right now it's bucking the trend. Like, Toowoomba prices are not going down. Those of you who live in Sydney or Melbourne, you listen to the media, you're probably like, oh, everything is going down in value, right? And this is just so wrong. It's, prices are going up in value. Try to buy a house in Toowoomba right now. I dare you, it'll be difficult. Why? Is because there's so much competition. There's more demand than there is supply. So places like Centenary Heights and Harristown, all these types of locations, right? I mean, they've got so much legs on them, and there's still almost neutrally geared property there in some instances. Perth, according to this, is in its upswing. I would still say it's in its recovery. Okay, this is for detached houses. I will go to apartments and townhouses in a second, but Perth, I think, is still in its recovery. Yes, places like in Rockingham have gone up 40, 50% in the last 1.5 years, but there are other parts of Perth that haven't. Typically in Perth, closer to the ocean on the left-hand side or the west side, those are the suburbs that sliver next to the ocean, north and south, that rise first, and then that kind of price movement or ripple effect goes inland from west to east. So those middle, like Alexander Heights and going in sort of more eastern suburbs, those areas haven't quite even recovered, I would say, compared to 5 years ago. So, once again, there's markets within markets in all of these. Perth has got tremendous potential. Newcastle, I will almost say it's at the peak, to be honest. It's not dropping just yet too much, but I would say it's at a peak. I've got a property in Newcastle. I don't think it's rising in value anymore. So I would argue that it's more around here. Fraser Coast, yes, prices still increasing, but this is one thing you have to understand, right? Banks don't love Fraser Coast so much anymore, like Harvey Bay, Fraser Coast, because so many interstate investors have bought there, and that means that the banks kind of put it on its red list, oh, hey, that poses an extra risk if more than 50% of transactions are interstate investors. So just be careful at this point in the cycle of Fraser Coast. Bundy, charging along like a steam engine, you just can't stop it. I would say there's a lot of potential left in Bundaberg, so I would almost put it between recovery and upswing. And I would put Adelaide in this kind of between recovery and upswing as well, especially kind of in the fringe areas of Adelaide. There's so much growth still going on. The Salisbury area, the Morphett Vale kind of area down south next to the ocean. Lower yields, but there's still highly chased or highly coveted properties. Adelaide is still doing well. The reason these are really hard to comment upon is that higher or more expensive type of property, at this point in the cycle, they always fall, and they fall hard. But the medium or lower price property under 500, under 600K, those areas, even though it says Adelaide is falling according to CoreLogic data, it actually isn't. The prices of property that, suburbs under 500K, they're not falling. In fact, they're rising. So like, medians are distorted and truncated because of these markets within markets type of dynamics. Those areas under 600,000, I would still say, are in the upswing for Adelaide. Maybe a bit too late to get in there now. You missed most of the boom, but that's the fact. Canberra definitely coming down. Hobart, oh my god, I was wrong 2 years ago. I thought Hobart would start coming down. I'm happy to be wrong again, but I think Hobart is in for a tough ride for the next 5 years. No one can afford it anymore. Locals can't afford it. Interstate investors can't afford it. Rents no one can afford. Hobart, it needs some magic if property prices continue to go up. Albany, Wodonga, similar type of story. Like we bought a ton of property there, not me, but clients, last year and earlier this year, maybe earlier this year, mostly last year. But really, it's starting to hit the affordability levels in many respects. So you have to be careful. Bathurst, we didn't do a whole lot of buying. What's really interesting is that Dubbo is accurate in this one. It is right at the top of the market. You could have got something in Dubbo, like 2 years ago, even a year ago for like high 300s. Good luck getting it now for anything without an F, without a 5 in front of it. Anything under 500, you can't get. It's gone at $150,000. Sunshine Coast, very similar story. It is dropping in. Sunshine Coast is very expensive now, so there are no cheaper properties under 500,000-600,000. It's dropping. Tamworth, I completely disagree with Tamworth right here. I think it's in its almost recovery to upswing phase. The thing is, like only 6 months ago, Tamworth had only increased like 10% over the last 12 months. So whilst the rest of the property market in Australia had boomed 30%, Tamworth was like, like kind of like the black sheep, kind of way out back, 20 meters behind its mother. It was really lagging. And that means it hasn't really gone up too much. And all the data is really actually accurate for Tamworth. Not all parts of Tamworth, South Tamworth, East Tamworth, parts of Tamworth. So I think I would squarely put that well before the peak for anyone who's looking to buy. Wollongong just follows Sydney. And, Sydney's up here well and truly. Melbourne and Sydney, there's no doubt about it, are in their declining markets. So Wollongong always just follows like the cousin of Sydney, right? It'll go down much like Geelong is the cousin of Melbourne, and that will also go down. One thing I want to say is that, Western Sydney, Western Melbourne haven't really gone down too much yet, and it's kind of like this phenomenon. They're the more cheaper parts of those capital cities, so therefore their slowdowns or downturns will be less prolific or less profound or less acute than the rest of Sydney, Melbourne, but they will happen. So I think, Sydney, Melbourne, they've gone down about 10% or thereabouts so far, and since rates started rising. In fact, since the start of the year, the peak was about February. So I think now is the time where Western Sydney, Western Melbourne will start to kind of just taper off, because the rest of the more premium Sydney, Melbourne has already done so. Gold Coast is very interesting. Like here it's saying it's a downturn, but I suppose I completely disagree. I just got a valuation for my own property, the one that's my PPOR. I bought that at the start of the year, and the agent, this is just what the agent's saying, but I know a little bit about property, so I can kind of validate him. It's gone up about, $300,000-$400,000, like since I bought it, right? And, that is despite rate rises. So that makes me question whether there is a downturn in Gold Coast. Yes, property prices aren't really going up as prolifically as they were last year. Other places have gone up, like in Merrimack and Pacific Pine, Highland Park, like 50% in a year. That's definitely not happening. But I don't see prices really tapering off in any significant type of, quantum at all. So yes, there might be a downturn, but it's very, very, very shallow. And I think give it another maybe 6 months, a year, and I think buying conditions will be really, really interesting, attractive, and ripe for the Gold Coast. I love the Gold Coast. Launceston is a bit like Hobart. I think it's overcooked. Property prices gone up 50% in 2 years for because of what? Like most of the infrastructure has happened in places like Burnie and places like Hobart, not so much in Launceston. So I really see the carpet being taken away from underneath the feet of Launceston. One more chart actually. This is the apartments and townhouses one. Okay, so the previous one was detached houses. We should always try to buy detached houses, right? That's what we want to buy, established detached houses. But you can see here there's many, many more sub locations on the left hand side in the apartments and townhouses type of allocation. Whilst you absorb that, the leaving or the parting message I want to share with you is, if you're a brand new investor and you're thinking, is this the right time to buy or not? Look, I don't really care if you use me or not, but the message is, it is the right time to buy. And does that sound like a property spruiker telling you to buy properties regardless of what's happening in the economic environment? Yeah, sure does. It does sound a bit scammy, right, when I think about it. But it's a fact, all right? It's a fact. There are suburbs and locations, I say threes, where prices are increasing. And it's not like I'm making this up. You can look at this yourself through CoreLogic. If you look at capital cities, that's not going to be the case. If you look at big regional locations, at an aggregate, that's not going to be the case. But if you look at suburbs, you will find that, hey, hang on a second. CoreLogic is saying Perth is flatlining, but how come there's this suburb called Mariwa that has gone up like 30%? In the last year and is going up every single month? Hang on, CoreLogic is saying regional Queensland is coming down, but how come this suburb, Avenel Heights, is going up every week? And why can't I even buy a property because every property has 30 offers on it? This is the message I want you to take away, because inflation is eroding your money at a 6 to 8% clip per annum, right? The money in the bank is going backwards. If you've got money, do something with it. I don't care what you do, but I care about education, because ultimately in 40, 50 years time, heck, in 10 or 20 years time, if you leave your money doing nothing, you're just not going to be well off. That's a fact. And I hope that you can absorb that message with the humility I required when I started as well, because it's scary, but you got to take a bit of a calculated risk in any property market. Always remember, the most important real estate is the 6 inches between your two ears. Invest in that first before you do anything else. I'll leave links below to my podcast on Spotify, Google, and Apple Podcasts, and also my Facebook group with 25,000 people, where people know what's up. Join and get educated. My name's PK. Catch you later. Bye.